Hello, everyone, and welcome back to another episode of Sipping Wealth Live, where I bring you news, tips, and tricks on how to wealth up, y'all. So I'm definitely excited to be here with y'all and back. So this topic, I had quite a few people selling property and businesses and everything this past tax season. So I wanted to make sure I actually touch on this topic because it has been such a huge issue with people facing huge tax bills because they were unaware of the heavy tax implications of selling off their business or a property. That capital gains tax be hitting y'all. So I want to make sure I touch on this topic, give y'all the inside scoop, things to be on the lookout for. If you have questions, of course, make sure that you drop a comment in the comment section. And also those of you that are tuned in from, wherever you're tuned in from, Facebook, LinkedIn, whatever, go ahead and make sure that you head over to the Sipping Wealth YouTube channel and hit that subscribe button and the notification bell so that you don't miss out on any other Sipping Wealth lives, as well as making sure that you are sharing the live with your friends, loved ones, followers. Hit that share button so that we can continue to support the Wealth Up journey, y'all. All right, I'm going to go ahead and get it cracking. Again, if you have any questions while I'm live, drop it in the comment section. Or if you just want to say hey to your girl, hey, go ahead and say hey in the comment section as well, y'all. All right, let's go ahead and get in there. Let me see. Hold on. Uh-oh, something's a little off, y'all. Hold on. I gotta make sure that it's doing what I need it to do. Okay, because Facebook been playing lately. Been playing too many games, so I have to kind of make sure that everything is streaming properly. Hold on, y'all, my bad. And then we're gonna get into the topic. We're gonna go ahead and get in there. Okay. All right. I think we're good. Those of you on Instagram, hey. Same thing. Go ahead and hit a comment in the comments. Okay, there we go. All right, we're good. Okay. Awesome. So I'm going to go ahead and get into the topic. Again, if you have any questions, make sure that you hit it in the comment section. Drop, hey girl, whatever the case may be, and let me I'll go ahead and then go into it. So when I talk about when I bring up, I'm gonna go over what things to be on the lookout for when selling your business. I put both selling your business and property together within the same live because a lot of the tax implications kind of are the same as it relates to like ordinary income tax, capital gains tax, things like that. When it comes to selling a business or selling a property, but there are some differentiations. So I'm going to go over things to be on the lookout for when selling a business. Then I'm going to go over things to be on the lookout for when you're thinking about selling a property. All right. So make sure that you are tuned in throughout the entire live because I will break it down. I'm going to give you about 10 things to look out for in each category, and then you can do what you do with the information, lock it in, take notes, all that good stuff, y'all. Okay. All righty. So the first thing and the big thing is capital gains tax. Yes, if you have an investment and you're selling that investment, whether it's stocks, whether it's a business, whether it is property, you do have that capital gains. You tend to always have that capital gains implication, all right, when you're selling it off. And typically it can be upwards of 20% a tax if it's a long term asset. If it's held for more than 1 year, okay? Now, if you purchase and sell that property or asset, that business within a year of having it, then it's now a short-term asset. So you have short-term, you're looking at short-term capital gains tax. Now, short-term capital gains tax is you're essentially being taxed at the regular income tax rate. So let's say that's the only income that you had for that year was selling that business and you profited $50,000. So you would be taxed at your regular income tax rate, that $50,000 income, because you're going to be taxed at the ordinary income tax rate because you purchased and sold within the same year. Now, if you held that asset, if you held that business for multiple years, maybe you've been 5 years in the game and you're like, okay, it's time to go ahead and sell this business. Now you're looking at long-term capital gains. All right. So now with long-term capital gains tax, now you have those different capital gains rates. That you have that 10%, that 20% tax rate. But the good thing about it, it's capped at 20% currently. So instead of getting potentially hit with a $37,000, 37% tax bill, or generally estimated tax bill, now you're capped at that 20% marker versus being capped at the 37% marker on the ordinary income side. And that's just a benefit of holding the asset for longer than a year versus selling the asset in the same year you purchased it. Okay, so that's that benefit. That's the benefit of making sure of holding the asset just a little longer so that you can be taxed at the ordinary, so that you can be taxed at the capital gains tax rate versus the ordinary tax rate. All right. The other thing is your entity structure. So when selling a business, you want to take into account the entity structure, whether it's an LLC, an S Corp, a C Corp, a partnership, depending on what the entity is actually structured as, is going to affect the sale of the business. So you definitely want to make sure that you have that ironed out, or maybe you're like, hey, I want to, make sure that the business is a C Corp before I go ahead and sell it off. Or I want to go ahead and make sure that the business is this. I don't want a partnership when I sell it off. However the case may be, but it does play a big part when it comes to selling off a business as it relates to your entity structure. So that is something to consider. The other thing is like the sale of an asset versus, say, a stock. So if you're selling a portion of the business versus the business and total. So a portion of the business, you are subject to still your capital gains tax, things like that, because of that stock, how that stock is doing within the business. So let's say, hey, I am selling Strategic Tax Accountants. And I'm like, hey, I have 5,000 shares of Strategic Tax Accountants. I want to go ahead and sell 1,000 of it to so and so. Now that person now owns 20% of the business. Now, if that person wants to then go sell that 20%, and now that the gain over that period of time that they had on that 20%, the business over that time period grew by 15%. And now they received they received a capital gains of $15,000 when they went to go sell their 20% share of the business. Well, that $15,000 is just a stock sale, not necessarily a sale of the business in total, but it's just a portion of it. Right? So that's just the differentiation between, okay, selling the asset in total, the entire business, versus selling that portion of the business. Still, when you're selling the entire business as a whole, you have to evaluate do an evaluation of the business. All right. So how much did the owner put into the business to get it started? What are the a basis over time where there are things that needed to be done to go ahead and get the business ready for sale. And then what is the current valuation of that company? Based on that, you're going to come up with a number to figure out, okay, now this company is valued at this. We're going to pay the owner for this business this amount of money. So, hey, this business was sold for $1.2 million. But over time, we had the depreciating assets. The owner put in this amount, whatever the case may be. So now, based on that, they come up with a figure, and that's where your tax bill is going to be based on. All right. Another thing is to be considered is PPA, which is your purchase price allocation. And the purchase price allocation is essentially the amount that is allocated towards the purchase of the business, and that helps with bringing down the actual tax bill. So anything, like I said, that's associated with getting that business ready to sell can help offset the tax bill. All right, so it is crucial in general when thinking about selling a business that you take into account what that you document properly everything, but also that you take into account, or what are the things that I need to actually do to make sure that I get the best value for the business, and that I properly notate everything so that I can keep my tax bill as low as possible. All right. Yeah, I gotta take a sip of water because okay. The next thing is your seller financing. So seller financing is a different way of selling your business. So if you're like, hey, that person that's purchasing a business doesn't really have it like that, but over time they want to make payments towards the purchase of the business. That's fine. And this way, it does help offset your tax bill throughout the course, because instead of them paying you $1 million when they purchase the business, they're saying, hey, I want to pay you $200,000 each year for the next 5 years, but I'm going to be purchasing the business for $1 million. So now, instead of recognizing, $1 million, now because of the seller financing, you're essentially spacing out the payments. And that kind of works the same way when you're doing an installment sale as well. So an installment sale is just saying, hey, I want to spread out the giving you the payments for the business over time, so that so that the seller doesn't have to take a huge tax hit in 1 year. Sometimes it works where the seller's like, hey, I don't want to take that huge tax bill. And other times the seller's like, look, I want my money. So I'm going to go ahead and take the tax hit. All right. So it really depends on what you want to do. Next thing is goodwill and intangible assets. So a lot of times this has to a lot of times have to do with businesses that have patents, trademarks, maybe softwares in the company, and this has to be taken into account when selling off the company, because those intangible assets have values on their own. So they can either be sold separately, or if they're sold in conjunction with the sale of the property or the business, they still have to be valued separately, so that we're able to determine what the goodwill or the actual value of the intangible asset is. For tax purposes. The other thing is depreciation recapture. Depreciation recapture, if there's assets, for example, vehicles. So a lot of the times when you purchase a vehicle, people are like, oh, I want to take a 179 deduction, or maybe real estate. I want to take a 179 deduction and accelerate the deduction on the property because, I need to decrease the liability or the tax hit. You could do that, but the normal depreciation on that asset is, say if it's a property, say if it's a long-term real estate property, that's 39 years. So if you're like, hey, I want to go ahead and accelerated depreciation on that now, and you sell it beforehand, now you have to recapture the depreciation from that time period, from the time period that you didn't actually hold the asset for. Let's do a shorter amount of years, a vehicle. So if you have a vehicle for that vehicle is depreciation. The normal depreciation on a vehicle is 5 years. The normal depreciation on a vehicle is 5 years. If you say that, hey, I want to go ahead and accelerate that depreciation on that vehicle in the first year that I purchase it, then you're like, hey, I want to go ahead and do the bonus depreciation, accelerated depreciation on a vehicle. And if you sell that vehicle in year 3, then you have to recapture the difference of the depreciation on that vehicle that you are the expense that you took on that vehicle in the beginning. Because you already took a huge expense when you purchased that vehicle, you have to say, hey, because I sold it early, I have to now claim that expense that I took, the accelerated expense that I took as income. Now that's income as well as whatever gains that you had from the sale of the property. All right. So you do have to consider that the same way you have to do that when you're selling off a business. And then it also happens when you're selling off a property as well. So you do have to consider depreciation recapture. And because it could also, now you're dealing with an expense hit that you took in a future past year, and now you're having to pay income tax on that money. All right. Tax-free reorganization. Certain stock exchanges can be tax-free if it's structured properly. Just got to put that caveat in there. So there are certain stock exchanges that can be tax-free. So if that's the case, when you're selling off your small business, then or making sure if that's a goal of yours to sell your business, then you want to consider this. State taxes, depending on your state. I know in Florida, we Gucci. But in other states, a lot of states, most states, you have state taxes. So you do have to pay state taxes on the sale of a business, as well as the sale of a property. So you do want to consider what your state tax is going to look like if you do sell off that property or business. All right. Let me make sure I don't have any questions. Ooh, y'all, if y'all dropping questions, I ain't see it because I'm not looking. Okay. All right. We're good. Employee stock ownership. So the ESOPs. So if you do have, if you had been, if it's a certain company where you're like, hey, I want to make sure that I want my employees vested, and I want to be able to sell my employees stock of my company, and you have that, then you have to make sure that you're taking that into consideration when it comes to selling your business. As well as if you're selling your business in this format to your employees, you do also want to make sure that um, it is structured properly, and they do understand the tax. Well, it's not really your job to explain the tax hit to them, but if you are one of those that have employee stock options, yes, there is a tax hit for you. Having the employee stock option. All right. Gifting a business or interest in a business, transferring business interest to a family member as a gift. You can do that, and you can use the gift tax exclusion. So if you do have the gift tax, that can be a different way of kind of gifting a business or gifting a portion of a business to a family member or whoever, depending on how much it is, how much the business is worth. Business asset disposal. There is some tax release that can be given to disposing of different businesses and things like that. It depends if you really have to sit down. It's a very small case by case thing, as well as the deferred sale of of trust. But I just kind of threw that out there just a little bit. If those things apply to you, then it's best that you kind of sit down with a tax professional instead of just tuning into the live. All right, I'm gonna hop into the property side of things. Hopefully that was beneficial for those of you that watched this first part, talking about the sale of the business. All in all, for the sale of the business, make sure that you're taking into consideration that you have to get a valuation of the business. You want to take into consideration capital gains tax versus ordinary income tax, the entity structure of that business, whether you're doing a complete asset sale or just selling stocks or partial ownership of the company, seller finance, installment agreements. If they have intangible assets, if there are intangible assets within the company, and depreciation recapture, state taxes, all that good stuff. All right, I'm gonna hop into the sale of real estate property. You're gonna see that I'm gonna repeat a lot of the things that I kind of went over as it relates to the sale of a business, because like I said, a lot of the time it does go hand in hand. A lot of the tax implications of selling a business and selling property are kind of similar, but there are quite a few differentiations. But there are some things like depreciation, recapture, capital gains, things like that that are the same. And the state taxes, that stuff, yeah. Okay. Hold on before I hop into my next. All right. Okay. All right. So when selling a real estate property, one of the big exclusions that you want to definitely take into account is the primary resident exclusion. So this is for those of you that are living in that have lived in the property for 2 out of the 5 years that you've held the property. If you've held it for less than 5 years, if you're military, then okay. But if it was done because of government contracting something in regards to that, then cool. But if it was just that, hey, you wanted to relocate, then no, you don't get to take the primary resident exclusion. But a lot of people tend to stay in their properties for longer than 5 years, so they get to take advantage of the primary resident exclusion. All right. So with the primary resident exclusion, it's up to $250,000 in capital gains. Okay. Or if you're married, then it's $500,000. So, and this is capital gains. So how this works is, if you purchase the property for $200,000 and now you're getting ready to sell it and it's worth now $500,000. Well, now you have $300,000 worth of capital gains. Okay. Now, things that you can use to help offset this is preparing the property for sale. Maybe you had to do some renovations, whatever that can help offset, your capital gains tax. But let's say you have none of that, and it's a clean cut $300,000 worth of capital gains because you purchased that $200,000 and you're selling at $500,000. All right, so that $300,000, if you are single, then now you are subject to capital gains tax just on that $50,000 because $250,000 of it meets the primary resident exclusion. Okay. Now, if you're married, then you're Gucci, you're good, because now that primary home exclusion is $500,000 worth of capital gains, but you only sold it at $300,000 worth of capital gains. So you don't actually have to worry about paying any capital gains tax on that property because of that exclusion. It's one of those exclusion that's like, oh my gosh, yay, I qualify. Now, for those of you that are like, maybe say that person that's filing single and they have $50,000 of worth of capital gains tax to pay because it's their primary resident, and the exclusion is only up to $250,000. that $50,000, like I said, can be offsetted by things that you had to do to get the property ready for sale, as well as paying the realtor, whatever. So any money that came out of your pocket to get that property sold, that can be brought to the table to help bring down your capital gains tax. Okay. The next thing is like I kind of just went over. I said a bunch of times, it's your capital gains tax. Making sure that you understand the implications of that. If you purchased and sold the property in the same year, say like my investors, they purchase a property, they renovate it, and then they go ahead and sell it. Now for those of you that do it in the same year, yeah, I don't know what's going on. But I want to make sure my stream is not acting up. Oh gosh. Oh. Because my streaming platform is glitching. Okay. I think we're back. Oh gosh. Uh-oh. Okay. My streaming platform is acting a little wonky. So I just want to make sure that my people on Facebook in the group could hear what I'm saying. Not bad, y'all. Technical difficulties. All right, y'all. Okay. So just making sure that you understand the capital gains tax, whether you're being taxed at the ordinary income tax rate or you're being taxed at the capital gains tax rate. So if you held it for longer than a year or you're selling before that year. All right. The next is that depreciation the depreciation recapture. So depreciation recapture is taxed at 25%. Okay. So if you took a depreciation hit, an extra depreciation in year one because you was like, oh, or maybe you did a cost segregation on the property to accelerate the depreciation on certain goods, maybe 5-7 year depreciated goods or 15-year depreciated goods, whatever, not goods or items. And now you're selling the property off in year three and you have depreciation recapture. Well, it's going to be taxed at 25%. Okay. Now, if this is viewed sometime in the future, it may change depending on, what legislation comes out. But as of now, we're looking at 25%. For again, another thing to keep in mind is 1031 exchange. So 1031 exchange is beautiful because this is a tax deferral strategy. I mean, it is amazing because you could end up essentially never paying capital gains tax if this method is applied, like just rinse and repeat. Essentially, how the method works is you purchase a property for $200,000. Now a few years later, the property is valued at 500,000. You made $300,000 worth of capital gains, but you say before you closed on the property, you said, "Hey, I want to do a 1031 exchange." Now you have to do this at the closing table, okay? Or you have to do this before. Look, it's a tight window. Okay, you got 45 days to identify the properties that you want to do the exchange with, close by 60 days. It's intense. It's a short window. Okay, but let's say you identify the properties. Now you're like, hey, I'm looking at two properties that I want to do you have to identify at least three. So 3 properties that I want to do the 1031 exchange with. You identify the properties. Now your clock is ticking. You close on the sale. This $300,000 worth of gains. You say you take that money. You go purchase the other property with that money. Now the $200,000 that you originally purchased the first property with, you pulled it out. That's your basis. That's money that you had to put into the property to purchase that original property. Cool. But that gains, you can go ahead and put it into the next property. And the gains is just money that's outside of anything you had to do to get the property ready for sale. So if you had to renovate, if you had to pay maybe lawyers, legal fees, professional services, whatever, and at the end of the day, your gain on the property was $280,000 because you spent $20,000 on getting that property ready for sale. Then it's $280,000 that's subject to capital gains tax. But you told them that, hey, I want to do a 1031 exchange on that $280,000, and you move that money into a new property. Now, look, your tax bill just went from tax bill on $208,000 to a tax bill on no money because you didn't actually realize that gain. You just put it into another property. So you can keep doing this, rinse and repeat. Now that $500,000 property, you say a few years later, that $500,000 property is worth 1.2. Now you're like, oh shoot, I have a capital gains of $700,000. What do I do with that? You take that $700,000 and you purchase another property with it. Now you purchase a property with that $700,000. You purchase a property worth $2 million. I'm doing that numbers. Now that $2 million property, a few years later, is worth $4 million. You sell that property, you purchase another property, you do it another 1031 exchange. You could keep doing this rinse and repeat method. I'm just throwing out numbers to get in years out there to give you an idea of how this strategy works. But essentially, it is a tax deferral strategy. You could end up not ever having to worry about capital gains tax on the sale of a property, using this method. Because it's deferring the tax until you finally say, okay, I'm $2 million in gain. All right, I don't even want to invest in any more properties. I'm just going to take the tax hit. Okay. Bases. So bases come into your play once you step out of your single member LLC and you start purchasing property and large assets. You start dealing with bases. Okay. So you have your basis is going to be the cost of that particular property, plus any improvements made to the property or anything, and it can be offset by depreciation as well, your basis, or maybe money that was put into that property as well, which also kind of goes into the area of improvements. All right, so any improvements and then the actual basis, the purchase price of the property, or anything that came into play as far as getting the property to sell. So that's where you get your bases and your base adjustments. Your base, like I said, your base adjustments are going to come from depreciation, improvements, capital contributions, money that you're actually putting into that business or the sale, things like that. Those are going to adjust your basis of that property. All right. And like I said, it kind of plays when you're dealing with coming to play when you're dealing with your businesses, you're selling your businesses as well. State taxes. I know y'all can't get away with state taxes if you're in a state with state and local taxes, then got to put some money away for them too. They want a piece of the pie. If you're in Florida, like myself, then you're Gucci on the state tax side. Passive activity losses. So passive activity losses, and we're still talking about property here. Passive activity losses have to do with those property, like maybe you purchase a property and this is not your full-time gig. So this is just something that you do on the side. You own a property and you rent it out. Now, passive can offset passive, but you can't use, say, like your W-2 income to then offset, your passive income. That you don't mix the two pots. All right, but you can use your unused passive losses to offset capital gains. So let's say you invest in stocks and you also invest in property. And maybe you had $3,000 worth of, or let's say 10,000, let's use an even number. You had $10,000 worth of losses in your stocks. And you're like, dang, I had a horrible year. $10,000 down the drain. And you sold a property, you sold some land and you made $20,000 from that land. Now that's $20,000 worth of gains. All right. Now that $10,000 worth of loss can offset the $20,000 gain that you made on that land. So now you only have to pay taxes, capital gains, capital gains tax on $10,000 because you use the stock losses to offset that property losses. Now, if you are a real estate professional, okay, if you are considered a real estate professional as it relates to the IRS, all right, that means real estate is your gig. Like this is what you do full time. You materially participate in real estate. Then it's no longer considered passive. So it's now ordinary. You can use it to offset whatever. But passive has to offset passive. You can't use passive to offset regular income. All right, because there is this limitation. So generally that limitation is 3,000 on passive loss limitation. The other is foreign investments in real estate property. I had a few clients. I had the most recent client that was selling off property in Jamaica, where this comes into play as far as investing in real estate property in another country. You're still subject to capital gains tax. All right. Now, if you have to pay taxes to the other country as well as the U.S., then the U.S. says, okay, we'll give you a little break as far as the money you pay to that country, but the IRS still wants a piece of the capital gains for the sale of that asset in the other country. All right. Installment sales, like I said before, still applies. So if you want to kind of break up the money that you're receiving from the sale of the property and do an installment sale instead, and say, hey, instead of you giving me $200,000 for this property this year, you could give me $100,000 this year and then $100,000 next year, so that I don't have to pay 200,000 taxes on $200,000 this year. All right. And then also exclusion for involuntary conversion. So there is no gain that is recognized if the property is replaced under like certain parameters and things like that. So this has to do more in the realm of eminent domains. It doesn't generally apply to most people, so I'm not even gonna hop into that arena. But if it applies to you, you can set up a call and we'll talk about it. But yeah, y'all, that's it. That's it. Okay. So with selling off a property, generally, just to recap, you want to make sure that you're taking into account the primary resident exclusion. You want to make sure you take into account capital gains tax, 1031 exchange, like I said. Okay. Depreciation recapture, because people get hit with that. Okay. It can hurt. If you are planning on selling that asset within the first couple of years of having it, then you do not want to accelerate depreciation unless you are prepared to take that depreciation recapture tax hit. Okay. Bases is keeping in mind what bases are. I did go over that. State taxes, passive losses, and the passive loss limitations, foreign taxes and how that applies, installment sales, and also I'm not even going to say that the exclusion for involuntary conversions, but that does apply to some people. Not majority of the people don't have to worry about that. But yes, y'all, that is it. If you have any questions, feel free to reach out. Make sure that you are subscribed to the Sipping Wealth YouTube channel, and make sure that you are hitting the share button so that your friends, families, loved ones can wealth up with us. and join me next week for another episode of Sipping Wealth Live. Thank you, y'all. Have a great, amazing rest of your day. And don't forget, let's wealth up.